Hello everyone. In this video, I will be talking about US Partnership Tax Return Form 1065. If you are a CPA student, if you are a EA student, or if in general you want to understand Form 1065, this video is going to be very helpful for you. But before I start talking about Form 1065, it is important for you to understand what partnership actually is. When two or more people come together to start a business, that is called partnership. Whatever income or loss that partnership is generating, those two people will divide it between themselves based on an agreement. So it could be 50-50, it could be 20-80, based on whatever agreement they have decided, they can share that income or loss between themselves. Now that we understand basics of partnership, you can have this question as well. Why partnership? Why not corporation? So the basic idea of partnership is that you avoid double taxation. So the two partners, let us say that we have got Adam and James, two partners. They decided to form a partnership. And why they decided to form a partnership? They wanted to avoid double taxation. They did not want to pay tax at the partnership level and then again at their individual tax return on Form 1040. A partnership does not pay any tax. Whatever income or loss a partnership is generating, they will pass on that income or loss to the partner. That is why it is called pass through entity. So, this is the Form 1065. In this form, the most important line is line 23. This is the income of partnership, and this income will flow to the partners. In our example, Adam and James, we have got two partners. This 93,000 will flow to Adam and James, and then Adam and James will pick this 93,000 and will pay income tax on their Form 1040 to the IRS. So first section is income, and then second section is deduction. So partnership has gross sales, then partnership has some cost of goods sold, and then we have gross profit 320,000. From this gross profit, there will be some deduction a partnership is allowed. First deduction is salaries and wages. Remember, this is salaries and wages not to partners but to employees. And if a partner is getting some salary, that is called guaranteed payment. So, why is it that partner could get salary? So, let us say that out of two partners that we have, Adam and James, James is getting guaranteed payment of 40,000. Adam is not getting this guaranteed payment. So this partnership is of a sports store. They sell a sports product, and let us say James is the one who is working on weekend, giving extra time to this business, and that is why in the agreement it was decided that James will get guaranteed payment without regard to profit of partnership. Even if partnership is making loss, James will still get this guaranteed payment, and that is why partnership is allowed to deduct that guaranteed payment. So James will be getting this 40,000. James will pick this 40,000 on his schedule K-1. I will discuss what schedule K-1 is in a little while from now, and then from schedule K-1 this amount will flow to James 1040, which is individual income tax return, and James will pay tax on that amount. So now that we have discussed salaried and wages, guaranteed payment, there are other deduction as well which a partnership is allowed to deduct: repairs and maintenance, bad debt. After deducting everything, we have this deduction 227,000. This will be deducted from gross profit, and this is the partnership ordinary business income. This number is very important to us because partnership will flow this number to the partner on their schedule K-1, and from their schedule K-1, partner will pick it on their Form 1040 as income and will pay tax on that amount. Let me show you K-1. So since they are 50% partner, Adam will pick 46,500 as ordinary business income. You can see this is 50% of 93,000, and we have second partner James Smith. He will pick 46,500. In our example, we only have two partners, Adams and James, so it is easy for us to track that amount on their K-1. So what if there were 1,000 partners? In that case, there would be 1000 schedule K1. It would be very difficult to reconcile that, track that. So therefore schedule K is also very important. So that is the difference between schedule K1 and schedule K. Let me show you a schedule K. This is the schedule K. So this is nothing but the total of all the schedule K1 that we have. So there are two partners. First partner is getting ordinary business income as 46,500. Second partner is also getting 46,500. Since they are 50% partner, you can see it over here. So the summation of ordinary business income 46,500 and 46,500 is 93,000, which appears on schedule K. Schedule K and schedule K1 is very important in partnership. They are different line items. So line 1 is ordinary business income, which is your 1065. Line 23 ordinary business income. As I've said, this ordinary business income on page 1 is very important, 93,000, because this flows on the K1. So this flows on the schedule K, 93,000. This is the total of schedule K1. All the schedule K1, if you reconcile, it will sum up to line 1 of ordinary business income on schedule K. So one good thing about schedule K and schedule K1 is that the line items are same. So you can see the presentation is different, but if you see line 1 is ordinary business income, and if you see a schedule K, line 1 is ordinary business income. Similarly, if you see line 9A is net long term capital gain, and if you see schedule K1 and if you see line 9A, you will see net long term capital gain. So they have got same line items, so it is easy for you to understand that way as well. So one thing that you may be asking, like, if on form 1065 we have ordinary business income and this flows to the schedule K, ordinary business income line 1, why do we have so many other line items? On page 1 of 1065, they only show this line item ordinary business income, because other line items we call them separately stated. Why do we call it separately stated? All these line items are called separately stated because they impact partners differently. So they can impact every partner differently. Ordinary business income is business income minus business deduction, and then you arrive at ordinary business income. It is treated similarly for all the partners, but all these line items that you see, they impact all the partners differently. So you can have this question which is legitimate, that how can these line items impact different partners differently? So if you see this line, net long term capital gain, this is very easy to explain. Let us say that if this amount was included in this line item ordinary business income, then it will flow to all the partners, and we will not be able to identify if net long term capital gain is included in this amount ordinary business income, and this will be treated by all the partners similarly. So is it right? It is not right, because this line item net long term capital gain is treated differently for different partners. For some partner it can be even 0%, for some partner it can be 15%. So therefore it is separately stated. Another example that I can give you right now is cash contributions. So charitable contribution again is treated differently based on adjusted gross income of partner. So if charitable contribution, this is a deduction shown separately on a schedule K, that is why it is called separately stated item. Let us say if it was shown over here in this deduction section, charitable contribution, then this charitable contribution will be included in this ordinary business income, and partners will not be able to identify charitable contribution. And then the thing is that charitable contribution, partners can take deduction for this contribution at their level as an itemized deduction based on their AGI, adjusted gross income. That is why this is also separately stated. Same for section 179 deduction, it is treated differently for different partners, therefore separately stated. So all these line items that you see other than ordinary business income, they are called separately stated item. Ordinary business income is called non-separately stated items. So what is section 179 deduction? So your section 179 deduction is your depreciation. So it is a depreciation that allow you faster recovery. So if you have bought, let us say, asset for 500,000, you are allowed to deduct entire amount, recover the cost of the asset in the first year itself. That is section 179 deduction. It is different from the normal depreciation that we have. You are allowed to deduct normal makers depreciation in the deduction on page 1 of 1065, but you are not allowed to deduct section 179 on page 1 of 1065. So you can be asked this question in exam also. So as I've said, your focus when you see this form is that you should first always focus on this ordinary business income. How do you arrive at ordinary business income? What are included in ordinary business income and what are not included in ordinary business income? So you need to know that this is non separately stated item, ordinary business income. Anything other than ordinary business income, which is line 2 and other line items, they are separately stated items and they are not included in your ordinary business income. Okay, now let me walk you through this schedule K and schedule K1. You can see that ordinary business income is 93,000. You would already know by now that on a schedule K1 it will be half for this guy Adam Butler, and it will be half for the other guy James Smith, because they are 50% partner. So 50% is their profit sharing ratio. So ordinary business income is 46,500. If you remember, I already told you that we have guaranteed payment. This guaranteed payment is paid to partner for their service, and this is paid regardless of whether partnership has profit or loss. So this 40,000 is paid to only one partner in this example. It could be paid to both the partner, it could be paid to only one partner. This is based on the agreement. So this 40,000 in our example is only paid to James. So if you can see over here, James has guaranteed payment for services 40,000, and if you see the other guy Adam schedule K1, you will see this amount is not here. So this 40,000 James will pick it on his 1040 individual income tax return, and he will pay tax on that amount. This guy Adam will not pick it on his individual income tax return, and he does not have to pay tax. Now you can see we have interest income as well. So this is 500. If you go back to schedule K1, it will be 250, and for the James Smith also it is 250. So one more thing that I want to explain to you is that you see this ordinary business income, right? So this is ordinary business income. This is, as you can see, both the partners picked it on their uh, schedule K1, and from schedule K1 they will pick it on their 1040 and they will pay tax on it. So it is not necessary that this amount actually gets distributed. They will pick this amount regardless of the fact whether this was distributed or not. Even if this amount is not distributed, partners will still pick this amount on their schedule K1 and then on their 1040 and pay tax on it, because partnership does not pay any tax. You can see tax and payment, partnership has not paid any tax. If partnership has earned that income belongs to partner. Whether or not partnership distributes that income or not, that is irrelevant. Partner will still pick that income and pay tax at their level. So both the partners will pick this income and pay tax regardless of the fact whether this was distributed or not. Let us say 2 years from now this amount was distributed. So when it finally gets distributed, at that time it is not taxable, because you can see it right now. This amount both the partners picked it right now and already paid tax. Why will they pay it again? Why will they pay tax again when it gets distributed after 2 years? They already paid the tax, right? And partnership does not do double taxation. So it would be double taxation if they are paying tax right now on the income and then again on the time when it finally gets distributed. So distribution is irrelevant. If partnership has earned income, that income belongs to partner. Partner will pick that income on their schedule K1 and then on their 1040 and pay tax to the IRS. So this is very important concept. To summarize, couple of things are very important. Ordinary business income is very important. What all deduction you deduct from your gross income to arrive at your ordinary business income, you need to understand you don't deduct charitable contribution to arrive at ordinary business income. Why don't you deduct charitable contribution? Because charitable contribution impact different partners differently based on their AGI. That is why you don't deduct charitable contribution to arrive at ordinary business income. Charitable contribution is your separately stated items and you will show it separately on your Schedule K and Schedule K-1. Same as charitable contribution, this depreciation, which is faster recovery of the cost of the asset, section 179 deduction, it impacts different partners differently. Therefore, to arrive at your ordinary business income, you will not deduct section 179 deduction, but you will deduct the regular maker's depreciation. So this is important because in exam they can ask you ordinary business income, they can give you in question charitable contribution, section 179 deduction, makers depreciation. You would need to know that you cannot deduct charitable contribution from gross income, section 179 deduction from gross income to arrive at ordinary business income. You cannot do that. So this is important. You need to know ordinary business income. That is first thing. Second thing that you need to know is that this ordinary business income flows to partner, in our example Adam and James, because this is pass through entity. Whatever is income of partnership will flow to partner. Partner will pay tax at their level regardless of the fact whether this was distributed or not. That is irrelevant. So that is also important. Distribution does not get taxed. Partner does not get taxed when partnership finally make distribution. Very important to note. Third thing to note is that on a Schedule K, you have line 1, which is your non-separately stated item. Anything else is your separately stated items because it impacts different partners differently. Another thing is that on your 1065, you have salary and wages. This is for employee. Any salary that a partner gets, that is called guaranteed payment. A partner will pick this amount, so not both the partners will pick, right? If agreement says only one partner will pick, only one partner will pick on his K-1 because he needs to pay tax on this amount. This is his income. So this is the basics of partnership tax return. In the next video I will explain more about partnership. So if you're a CPA student, EA student, or if in general if you want to learn about partnership, do hit subscribe button, like and comment. Thank you so much.